Good morning, good evening, good whatever time it is you are listening to this. I hope you are having a great time. Now, I'm going to be going over the SPY for March 21st, 2025. I'm not going to be discussing the data or the earnings since there's really no data or earnings to discuss today. We have a Fed speaker, Williams, at 9:05 a.m. Other than that, it's no data. Now, what is important, however, we have the quad witching OPEX, which is, the options expiration. It's the major expiration that happens 4 times a year, but it's all the futures, all the options, all, whatever expiration based instruments are in the market expire on these days. So you essentially have trillions of dollars on the table trying to converge on very specific strikes throughout every single symbol. Doesn't matter what it is, they're trying, and by they, I mean the dealers, money makers, big hedge funds, whoever you want to, you know, address to whatever symbol you're looking at. Um, Whoever the big money is in that symbol, they're going to try to drive that price to a very specific point. So even though that sounds like the standard goal of every market day, that's really our big goal of today is to figure out where exactly they're trying to close the price, because that's how you get paid quite a bit. I'll discuss that a little bit more and where I believe that price is going to close at. But before we get into that, we will go over our standard technical analysis. Just a quick reminder before we get into the technical analysis. If you've been finding value in my insights, consider joining my Patreon. For just $12.99 a month, you'll get access to my trades, courses, and powerful tools to help you grow as a trader. I'd love to have you be a part of our team and community. And it's less than 43 cents a day. So if you'd like to join, click in the link in the description. Thanks. And getting straight into the technical analysis, we'll go over the Bollinger Bands and the moving averages as always. And discussing the moving averages, we have the 5 mile currently at 564.72. Since the market closed at 565.49, it's very likely we're going to see the 5 mile open basically smack dab right at the 565 area. It shouldn't be too much below or above that. It should be pretty much right there. Now we have the 10 mile at 562.63, and I didn't make a video the last 2 days because I just haven't been feeling too great. I apologize for that, but I did mention this in my Webull posts, that the 5 mile did cross the 10 mile today, which is a very bullish cross. I'll discuss that in a couple minutes from now. Uh, I just want to finish going over the rest of the moving averages and the Bollingers. We have the 20 mile at 575, 39. We have the 200 mile at 571.25, so not very far from us at all. We have the lower Bollinger at 544.85. That is quite a ways away from us right now. I don't think we're going to be traveling back down there for quite a while. We have the upper Bollinger at 605.93. As you can see, as the 20 mile pulls downward, the upper Bollinger will pull downward and the bottom Bollinger will pull upward towards it. So it consolidates, it collapses the range uh, of the Bollingers. When the 20 mile starts pulling upward again, it expands it. So as you can see, it started pulling upward, started expanding in this area, and then as it started pulling downward, it drops. That's just how the Bollingers work. Now a really important level to go over today is that the max pain is at 580 right now. It very likely will change in the morning when we get the open interest data, which once we get that all updated, it's very likely going to set the max pain around 576 to 577. But check the max pain in the morning. That's going to be extremely important because generally on OPEX days, uh, the dealers want a target for a very specific strike. Um, that max pain area coincides very well with a very specific little moving average right here, which is our 20 mall, right? Now, let's just talk about moving averages before I go over any structure or anything. Um, I've discussed this in some of my classes before, but the 5 mile kind of weaves in between each move. Um, this is a little bit of an exception, as this was a major correction. This doesn't happen very often. It's not something standard, but what the standard moving average um, movement will be is that, like for example, we had all the moving averages start pulling downward, and we were in the bottom Bollinger. When you're in the bottom Bollinger, what's the one moving average you can test first? Always going to be the 5 mile. The 5 mile is the 5-day moving average. That's always going to be your closest support because that's your short-term support. It's going to move the fastest up and down, uh, wherever the market goes. So you can always look towards the 5 mile. Uh, with that said, when the 5 mile gets tested, that then opens up the next moving average and the level below it. So since we had the bottom Bollinger and the 10 mile above us, we had the bottom Bollinger below us, 10 mile above us, and the 5 mile right where we were, it opened up the 10 mile to be tested. So we tested the 10 mile, had a little rejection, retested the 5 mile, it opened up again, the bottom Bollinger and the 10 mile. We saw the 10 mile get tested again. And finally, as of, Thursday the 20th, we saw the 5 mile cross over that 10 mile. That's a very bullish sign because that's showing that your 5 mile support is crossing over your 10 mile support, your 5-day support's crossing your 10-day support. Your short term's crossing over the medium term. So the next move from here generally is going to be targeting that 20 mile. Now, since that 20 mile is at the 575-39 range, and as we start pulling up towards it more, it's going to start pulling up a little further, so it's very likely going to be in that 576 range as we start actually heading towards it. Um, that coincides very well with our max pain level. If we get that max pain around the 576, 577 range, even 580 range, that puts the 20 mile well within testing range. Um, and what I mean by that, sorry, I have to adjust my microphone really quick. What I mean by that is that when you test a moving average, you generally test $1 to $2 below and above the range. So with the 20 mile being essentially at 575 right now, that opens up 573 to 577. Um, it's very likely we're going to start seeing uh, movement towards that area, and we know that because we're already seeing movement being pulled towards that 200 mile level. So the market's already trying to tell us that it's wanting to break above this level, or it's trying to consolidate support to break back down. I don't think it's going to break back down quite yet, but we will see. Tomorrow's basically, or the 21st Friday is going to be a very decisive day, uh, primarily because this OPEX is really going to determine whether we're going to break out of this 200 mile range within the short term or not. If we don't break that range very likely tomorrow, then we're very likely going to reject pretty hard. So that's kind of my expectation for now is target the 20 mile. It's very likely we're going to head up towards that level to test it. And just going over, let's go over the 1 hour chart. I want to hide the moving averages and Bollingers. All right. So over the last few days, we had that lower low, and I just want to draw this out. But we do have. I'll talk about these boxes in a second because these actually matter. But we have the inverse head and shoulders formed. Okay, we have the head built We have the left shoulder built, and now we're working on the right shoulder liquidity. And with that liquidity, we have some really key areas up in here. I want to scroll down a little further, but I want to pull out the horizontal rays. So each of these levels are important gaps. Okay, and as we start heading upward, we're going to start seeing many of these gaps starting to be closed. As essentially they form cups upward. Um, Sorry, I'm losing my train of thought as I'm trying to delete these drawings and everything. Um, Essentially, we're starting to see cups upward. Okay, and we saw that within today's session, and we saw that within the last 2 day session. So just to draw this out a little better, we had this very large cup right here, and then we had the handle form, and then at the very top of that handle, what do we expect? We expect a bearish structure, or at the top of the breakout of that cup anyway. We expect a bearish structure, and we expect to head downward to build a handle. Now, with this handle, okay, on this larger cup, I made it look like a cup and handle, but it is a larger cup. We saw the top of that cup pull downward, pull down towards the bottom, and now we saw the cup, or we saw the handle actually form a cup. That's generally what you want to see these larger handles do, is form a cup. That's a bullish, uh, structure to this. And we see this handle basically forming another cup and a handle. And then now we just need to see the full breakout. Okay. What we should be looking for with these breakouts are these liquidity zones upward. It's kind of harder to see when I have the chart that way, but let's take a look at some of these gaps. All right, so we have that 573.67. Okay, I've been talking about that gap all week. It's very likely we're building liquidity to take that gap. Okay. If we take that gap, then, what's the next gap above that? The 577. Where's the 20 MA, right? Within that range. So that basically pushes us up to that gap. And just to highlight this, hold on. Sorry, my thoughts are a little scattered right now. I've had a very long week. Okay. Sorry if you can hear my daughter screaming. Okay. Anyway, what we should be looking forward to is essentially more structure building upward, filling that gap, hitting the 573.39, forming some sort of rejection and some sort of breakout to head upward, and essentially continue heading up like this. As that's how the structure heads down, and that's how we're starting to build it upward. Okay. If we're going to continue heading downward, we're going to continue seeing a lot of these inverse cups. Now, we do see a little bit of an inverse cup here. That was a little worrisome, but that was between the after hours and the pre-market, and that was basically nullified. So what that was doing was building just more liquidity in this area. So as you could see, built a cup right there. Now we're just building out a handle, and boom, we're right in that structure. So hopefully that makes sense. Hopefully that's not too complicated or anything. But with that previous structure building out, it's very likely we see, this inverse head and shoulders fill out, and it's very likely we start seeing a lot of these gaps being taken. That's kind of my expectation for this OPEX. Now, just to highlight the bearish scenario, because I always have to regardless. Let's just say OPEX, the dealers want downward more. I highly doubt it, but let's just play that scenario out. We can see an inverse cup form here, and the reason why we could see that is because um, this is the bottom of a handle on an inverse cup. There's this large inverse cup right here, and it looks a little better on the daily chart, so I apologize, but essentially this is a very large inverse cup. This is the top of the inverse cup's handle, and now we're looking for the bottom of a handle. I would generally expect it to be in this range. So if it's going to just build right there, then that's a little bit of a surprise to me. But what we need to be looking at is this potential head and shoulders right here. Okay. So if we're going to see this head downward, we're going to see this right shoulder fill out, and we're going to see the rejection back down to that 549, the 550. That's where the lower Bollinger is at the 544.85. So if we start pulling down there, that's, essentially right close to the bottom of this channel. Um, I don't think that's going to be the scenario, just because I'll talk about these liquidity boxes in a second, but just because of where the max pain is, we have been seeing the ADL, which is the money flow, pulling upwards slowly. We have the 5 MA moving average broke above the 10 MA. Now it's slowly heading towards the 20 MA. It's very likely going to start breaking past that 200 MA range within the next 1 to 2 trading sessions. I see these all as bullish signals. Now, to go over these liquidity zones very, very quickly, I don't want a vertical line. That's what I want. Okay, so just to quickly explain these liquidity zones, and I apologize for that. Let me delete that. I don't want this either. Ugh. I want that. Okay. All right. So to quickly explain the liquidity zone, this was the very, very bottom and beginning of when President Trump was elected and when the rally started. Now that rally carried over all the way down to this point, and we call this the bottom of the rally right now because that it's breaking under the level of where the beginning was. We have a top to this rally, we have a bottom, so we have a very defined area of liquidity. This area right here is also a very defined area of liquidity. We have, this very big move from, breaking from that rally, essentially, putting us into a new structure here. And with this new structure being broken out of, we're starting to pull back into this structure. And when that happens, essentially we go from top to bottom, or I mean bottom to top, bottom to top. So, not saying that's going to happen, but that's kind of how these structures play out. We re-enter that liquidity zone, and then we are within the playing field again. All this liquidity opens back up, and we can now trade between this area, and hopefully that makes sense. I'll explain a little better at another time. Overall, I am bullish. I am seeing bullish structure. I'm seeing bullish indicators. I'm seeing the VIX being pulled down significantly. I've talked about this in the past, and haven't talked about this in the videos though. But generally, when the VIX is above 20, I consider that kind of like the bearish territory, as that's showing that puts are actually being written on the S&P or on the SPACs. But when the VIX starts pulling under that $20 range, that starts showing that the puts aren't being written as much and buying is starting to happen. So even though the buying has been very weak over the last few days, we've essentially gone from the 549 all the way to the 570. So this alone has been a very massive recovery. And with that very large recovery, we just need to continue looking upward and start filling these gaps. There's plenty of these gaps to fill, and it's very likely we are going to start seeing that happen. With that said, um, yeah, we should be looking for a pretty bullish OPEX. Um, I wouldn't be trading zero DTs today. I would very highly suggest trying to target dated contracts at least for 2 to 3 days out. The reason why I say that is because OPEX moves absolutely a ton. You can see a $25 range tomorrow potentially, and what I mean by that is with the market essentially being right now at 564, we could pull all the way close to the 580 range and pull back downward. Say we pull up to that 580 range, build a cup right here, then we can then form a handle and reject. Um, so we could see a full, 10, 15, 20, $25 range on the SPY. Um, don't mistake that. So I wouldn't be playing zero TTs too much. Um, when I do play zero TTs on OPEX days, it's generally very close to when the market's getting ready to close, so that we can really lock onto the specific strike, and generally those contracts will double, triple, quadruple in price by the time you actually hit that strike. So that's what I do look for. Um, yeah, overall, bullish on the day. Should be too. The 5 mile support's being pulled up. A lot of good bullish signals. I'm really not seeing the bear's thesis here unless we fail some breakout and reject the 200 mile again and have some major sell off. That's what I would assume the best case scenario would be for the bears. Other than that, I see us having potentially an extremely bullish day tomorrow. So with that said, I'll stop my rambling. Have a great night, have a great day, trade safe, have a great weekend, and I will talk to you in the next video. Take care.